The main concern when it comes to hurricanes, severe weather is, people, safety, their homes, things like that. But there certainly is an investor impact to this as well. Give us a sense. How are insurance stocks impacted when we see a hurricane or another severe weather event?
And obviously, there's a cost, but it's important to remember that these companies essentially expect to have a hurricane or two every year, so it's usually within expectations of what they're going to have for every year. And then the net effect is a little bit of increase in demand as customers recognize that they need the insurance after these events. And then also a reminder to the companies themselves that they should remain disciplined when it comes to underwriting. The net effect is usually a net positive from an economic perspective for the insurance companies, even though they're taking obviously a significant loss for the event itself.
Paul, I got to say, that's honestly a bit surprising. We're just looking at a few insurance stocks, AIG actually trading higher this morning. Pretty interesting. So something else that's pretty interesting is that you actually recommend dollar cost averaging into insurance stocks ahead of a storm. Explain this thesis. What's the benefit of dollar cost averaging before they have this kind of disruption?
It really has to do with two things. One is that the stock prices typically go down in front of an insurance event of like this, and then typically respond because insurance investors, like every other stock investor, they don't like uncertainty. And as the uncertainty goes down, pardon me, as it increases, you see the stocks going down. As the event involves itself and you understand what's going to happen here, the stocks typically rebound. You dollar cost average because hurricanes are unpredictable. You never
Okay.
know what's going to happen. And so the only way to pick the bottom is to do it with a dollar cost averaging process.
I just want to be clear.
I
So
don't think
you're basically buying the dip into the storm because the stocks go down right before the storm and then they kind of go back up to their previous level right afterwards.
that's exactly right.
Really interesting. Okay. One other thing I want to talk to you about. So a year ago, Hurricane Ian had caused an estimated $100 billion in damages. I know you sent us some estimates from other storms, but then you have to inflation adjust. This was just a year ago, so basically the same dollars over that period of time. You say the insurance companies, they prepare for these events, but when you see this kind of damage and we're seeing more and more of these big storms, how does that impact the premiums that consumers have to pay? And then long term, how does it impact the top and the bottom line of these insurance companies?
But it's not a specific, company or situation that ends up, but generally you'll see higher prices following an event. You saw much higher reinsurance prices, for example, following Hurricane Ian. So, the customers pay more after these events because insurers and reinsurers become much more disciplined and essentially pass on the cost to the customers.
But is it a long-term tailwind for the companies themselves? Does all this, these higher premiums, does it actually trickle down to the bottom line?
It does. Eventually, it trickles down. It doesn't happen instantaneously,
Right.
but over the course of the next year and a half, you'll see rates increase, prices increase, and it'll ultimately trickle down to the
Okay.
insurance company.